Hi. Welcome back to my channel. Hope you guys are gaining value. So today's topic is high probability entry model. It's a high probability on how to enter a trade when you see your amazing setup. And a big shout out to my coach. I always give a shout out to him every time. So now the market moves from is a sequence from internal range liquidity to external range liquidity, and from external range liquidity to internal range liquidity. Now, how does this work? Firstly, you see a higher high, higher low, higher high, higher low. In the simplest form I can explain it for beginners, you see a break of structure from here. We call it a BOS. You see a BOS in that area, right? But normally that is external range liquidity using the daily time frame. Buy side external range liquidity if you are using the advanced class for ICT. But for those that are still baby or still retail trader, we call it higher high, higher low, higher high, higher low, higher high. Now, we don't buy market high, we buy market low, and we don't sell market low, we sell market high. Now, what do I mean by that? When you see a higher high, higher low like this sequence, you take your Fibonacci from this high to the low. Let me do the Fibonacci so I can show you how what I did. I went to my Fibonacci here and I took it from the high to the low. The low here is discount while the high is premium. The rule states that you buy in premium, sell in discount. That's what we know. We are selling high and we are buying low. But at the moment now, market is selling, so we want to sell. Now, of anything above 50% is your premium. The sense whereby when it's your premium, you are looking for institutional reference point above that premium. Other block, fair value gap, liquidity void, breaker block, mitigation block, different kind of fair value gap, implied volume inversion, the type of fair value gap that you want to trade, volume fair value gap, everything must be in that premium zone as your higher time frame POI. In case you see them, you look at this and look for those institutional reference points. Now, when you're on your higher time frame, market does this as a straight line, right? But if you go on a lower time frame, when you go on a lower time frame, market moves like this. And that change of character, can you see that? When you're on a lower time frame, so that break of structure is what we see here. Sorry, okay, I drew it wrongly. I'm going to delete that. Is for a buy. Let me draw for a sell because it's sell I'm teaching you guys with. So sell is like this. I'm sorry, my drawing is very bad. Okay, like this. And this is what we call what? The break of structure here. Right? The break of, sorry, not the break of structure. That's not for a buy. Let me put a line here. I'm trying to get a good drawing for you. Now, what do we see? What I'm trying to draw for you here is this movement, this direction. Market is coming down from here. Market did this, right? Market is doing this. I'm not getting the drawing very well. But what I'm trying to explain to you is this. This is the low, which is here, right? And what do you see? Market climbed up to the POI, an assumption where we have a POI, right? Which is like our fair value gap around here. Our fair value gap around here. Market has moved into the POI and we have an assumption, we have an order block around here. If you go to a lower time frame, this is how you're going to see market movement like this. This is how you're going to see market movement like this. Now, what are you waiting for? You're waiting for market to do what? A change of character, sweeping out this external range liquidity and coming back again into an institutional reference point before going down. Now, there are two types of traders in the market. We have aggressive traders and we have conservative traders. Aggressive traders only mark their POI. Aggressive traders only mark their POI and get into the trade, making market get to that zone. But being a conservative trader, you take your entry like this, marking your institutional reference point, either your fair value gap order block, enter institutional reference point, and you put your entry wherever you marked, refine your zone, and you target the overall external range liquidity. So it can be order block, it can be mitigation block, it can be breaker block, or it can be fair value gap. Now, going into the charts, I'm going to just give only one example. What do I see here? There was a shift in market structure here, which market violated. Can you see? Market took out an external range liquidity here, which is a buy side liquidity. For those that advance, you will know what they call buy side and sell side liquidity. But for those that are not advanced, I will call it a shift in market structure, MSS, right? For your understanding. Now, what am I seeing here? I'll take my Fibonacci from the low to the high. From the low to the high, right? Don't forget the rule I said, below 50%. Below 50%, you bring out all your institutional reference points. Is it order block? Is it fair value gap? Is it fair value gap? Is it inversion plight fair value gap liquid? All those institutional reference points, order block, you bring everything out and look for it below 50%. Now, what do I have here? I have order block here, which I have marked. This is the only thing I'm seeing below 50%. Are you seeing this? Now, you come down to 4 hours to just get a good refined entry. And you're waiting for markets peacefully to come down to that zone. This liquidity being created because market has not touched the seasonal reference point. That's many of us do make our mistake. Now, I'm waiting for markets to clear this high on 4 hours for me to be able to take that thing as a sell with a body. And what happens when market does that? You can also mark come down to as low as 1 hour. I'll have gotten my entry here. But for your understanding, I'll take my low to my high. I have what here? I have a fair value gap here. I also have a breaker block, but on premium. My breaker block is on premium, which market might still react in. Now, there are two different things you put into consideration, right? I'm going to show you an example. Now, there's a premium here, which I have here. There is a breaker block here, right? And if I look inside my eyes deeply, I would see an implied fair value gap. If I measure it here, an implied fair value gap, which I'll put a line there. This is just to, this strategy I'm showing you, not strategy, but method I'm showing you is just to help you to refine your zone, right? Not to be aggressive. I will have an order block here, which is even almost above the discount. Order block as confluence number. Look at how long the candle is. Now, I'll come down to 15 minutes. This blue line is showing me order block, breaker block. The black line is showing me what? It's showing me implied fair value gap. If I look again down, I'm seeing what? I'm seeing a minor tiny fair value gap below. Now I have marked all my stationary reference point that I'm expecting markets to react in. What are you going to do? You are going to be patiently waiting for price to get touch any of this zone and price touch our breaker block. And what do you see here? Price came and created another breaker block, refining my entry. And what will I do? There is a fair value gap here below. I'll put my stop loss above here. It's still a risky trade because the rule states that buy low, sell high. It's still a risky trade, but markets can be mad and crazy sometimes. Then what are you going to do? You come as far as 1 day and you'll be looking at what? You'll be looking at the next draw on liquidity. I have a draw on liquidity here and I also have another draw on liquidity above here, right? You come down to 4 hours. I'm not doing it down for you, but just to just teach you how it works. You put all the places you expect markets to react in. You measure this to this level. You put it at what do you say, this consequent encroachment? Then you come down to 15 minutes. And all these black lines are going to be my take profit. Take profit 1, take profit 2, and take profit 3. You know when to break even. you know when to leave the market and you run away. I use that word a lot, run away. Now price hit take profit one has been taken out, right? Take profit two has been taken out. I keep watching. Now this how we do it. It's very very easy, not so straightforward, not so stressful. But and take profit three has been taken out, and indirectly you've done 1 to 8 trade. Using a conservative entry, you wait for a shift in market structure to take place in the market. Very straightforward. From a higher time frame, you keep waiting for a change of character using the same rule I showed you on the chart. Let me show you back again. Okay, it's kind of messed up here. Using the same rule, your higher time frame here, entry either at your fair value gap, your breaker block, your mitigation block, or your other block. You are waiting, you can keep refining and refining to get a bigger and bigger and bigger risk to reward entry for your trade. So I hope this is very impactful for you. Ask your question in the comment section. If you do not understand anything, message me and I'll be happy to and glad to reply you. Thank you very much. Hi, welcome back to my channel.